Earlier this year, I posted 2 videos about Sirius XM. Both videos did very well. But the investment I made in Sirius XM did not do well at all. Actually, it is one of my worst mistakes this year. Probably the worst mistake this year. And today we are going to talk about Sirius XM, the stock after the merger, because it looks more undervalued than it was when I first invested in it. And Warren Buffett has been investing more and more in Sirius XM. Does this mean that it's time to buy the stock or not? We'll talk about that. But first, let's talk about the mistake I made with the arbitrage. I was expecting that if Sirius XM and Liberty Sirius XM are going to merge and Sirius XM stock price, SIRI, was the highest one, the price of Liberty, for simplicity, let's call it Liberty, was going to go up and meet the price of SIRI. But the opposite happened. SIRI was the one going down, and with it, the price of Liberty. Today, Sirius XM is even cheaper than it was when I first invested in the company. And that's probably why someone as Berkshire Hathaway, I won't say Warren Buffett, has been investing so much in the company lately. The situation with Sirius XM has not changed since I first looked at the company. It still has a moat. If today you are buying a new car in the United States, most probably you have satellite radio from Sirius XM, and this is a moat. The CEO of Ford, the CEO of GM, they are not waking up every day thinking about changing their default satellite radio provider. They are thinking about making EVs, they are thinking about tariffs, they are thinking about something else, but this is not something that goes into their minds. So you can be sure that over the long term, the moat is still going to be here. But there is something else. The revenues of the company over the long term are going down because people don't want to keep subscribing to satellite radio anymore. They prefer to have podcasts. Yes, the company is investing in podcasts. They have started Pandora, so they are investing in growth. But unfortunately, the growth is not here right now. What is happening is that all the capital expenditures that the company are investing in growth is not bringing any growth. Over the long term, revenues seem to be going down and down. There is nothing wrong with that. It is possible to invest in a company that is not growing. But the company should not keep putting money into growth when no growth is expected. This reminds me of a country I visited a few weeks ago, Luxembourg, which is officially called the Grand Duchy of Luxembourg. Why is it called the Grand Duchy? It's the only country in the world called a duchy, and it is called the Grand Duchy. It's because a few centuries ago, there were other duchies and grand duchies in Europe. But it's the only surviving one. In a way, we can say that it has a moat. It's the only one that survived. The competitors died. But that doesn't mean that today, Luxembourg, which is a very small country, that they should go and try to expand their territory. Because before, there's a province in Belgium called Luxembourg. It used to be part of the Grand Duchy. That doesn't mean that Luxembourg today should go and fight Belgium. This is going to be very poor capital allocation. Instead, they are taking their cash that they have, very rich country, and giving free public transport to its citizens, which is something that most countries cannot afford to do, but they can afford to do it. This should be what we should expect with a company like Sirius XM, which is on the decline. There is nothing wrong with declining revenues. But you need to take your cash, and Sirius XM has a very strong cash flow generation, and return that cash to shareholders. Pay dividends. They barely pay any dividends. Buy back shares, which they don't do. This is what Seas Candies has been doing as part of Berkshire Hathaway. It is not growing, but they are paying a lot of dividends to the parent company, Berkshire Hathaway. And another company doing that today would be Tegna, Coles. These companies are not growing, and they are not investing in growth. They are instead returning cash to shareholders. And by the way, you can always find all my analysis on the Superinvestors Club. I have created the Superinvestors Club. I post all my analysis there. There are even courses, investing for beginners, courses about how to look for companies. You can find my watch list. Everything is available there. You can even check it out for free if you're interested. I'll put the link in the description and in the comments. But I, as the investor looking at this today, I made a realization as a value investor, and I believe every value investor at some point make this realization that is it worth it investing in such a company? Because you have so many options in front of you. Value investors try to look for the companies that everyone is hating, and Sirius XM probably is one of such companies. But is it worth it? I would rather invest in a company like Booking Holdings that everyone seems to love, but they are not loving it enough. I believe it is undervalued. Not that much, but it is still undervalued. Crocs is another example, but the market is like Crocs right now. It is undervalued. And you look at Crocs, you look at Booking Holdings, these companies do not require a lot of capital to grow. With little capital, they are growing their earnings and consequently intrinsic value, which is not the case for Sirius XM. They are putting the cash into growth, but not generating any growth. It's better to return the cash to shareholders. Charlie Munger was probably the value investor who realized this at the youngest age, because he was the one encouraged, inspired, I don't know the right word, Warren Buffett, to invest in such companies instead of looking for deep value opportunities, bad companies, but which are very undervalued. I can invest in Sirius XM again, but I would need to invest in it only it is massively undervalued. Not right now. I won't say it is overvalued. It is generating about $1 billion in free cash flow every year. And if you discount that, even you account for falling revenues, that maybe in 10 years, this is going to be only 700 million in free cash flow. It is still undervalued. It has a lot of debt, but it is still undervalued. But when I look at the alternative, I would rather invest in Crocs. I won't invest in Booking Holdings. It is not that undervalued right now for me. I would rather invest in Crocs, which I see as a better opportunity. That's why you should not follow the great investors. It is probably Ted Weschler who invested in Sirius XM, not Warren Buffett. His portfolio is different than yours, different than mine. He has maybe, let's say, 15 billions to invest. Let's say you have less than that. I hope one day you have more, but today you have less than that. You have more opportunities. You can invest in smaller companies that are not available to him. And if you don't have the time to invest in such companies, then just invest in an index fund. There is nothing wrong with that. But to make the work to look for such a company that is not that undervalued, it is not worth it. If tomorrow the stock price of Sirius XM falls by 60%, then I will invest in it. There is a big margin of safety. Today at this price, no. If you want to know more why I'm so bullish on Crocs, I would recommend you watch this video next. Have a nice day and goodbye.